The energy markets are at an inflection point this May, with tectonic shifts that demand our attention. Let's dive into the current reshaping of the industry landscape before the mainstream catches up. The crude market faces serious headwinds, and OPEC Plus just turned up the heat. They're accelerating the unwinding of production costs, planning to add 40.41 million barrels a day in May alone. This move couldn't come at a worse time for oil prices, with Brent already struggling to stay above $60 a barrel. The supply-demand equation is getting more lopsided by the day. 4 countries, Guyana, Canada, Kazakhstan, and Brazil, are set to add 0.7 million barrels per day in 2025. That alone could satisfy the projected global demand growth of just 500,000 barrels per day. When you factor in OPEC Plus turning up the taps, we're looking at a recipe for oversupply. Global inventory days are projected to balloon from 43 days at the end of 2024 to nearly 48 days by the year-end 2025, and could hit 51 days by the close of 2026. That's a lot of oil shifting or just sitting around in storage with nowhere to go. The U.S. shale patch is feeling the pressure, as Diamondback CEO recently warned on CNBC. U.S. oil production will start to decline due to the price plunge, end quote. We're already seeing the effects. Diamondback is dropping 3 rigs and cutting 10% from their 2025 capex. EOG Resources, one of the steadier operators, is making strategic adjustments across their portfolio, reducing Delaware Basin completion count by 15 wells, dropping 1 rig, decreasing Eagle Ford completion count by 10 wells, lowering Powder River Basin completions by 5 wells. Despite these cuts, EOG still managed to beat Q1 earning expectations with adjusted EPS of $2.87 versus $2.80 consensus. They're maintaining 2% year-over-year oil production growth despite $200 million in capex reduction. That's efficiency in action. While oil markets struggle, natural gas is showing structural advantages. EQT Corporation, the largest U.S. natural gas producer, delivered strong Q1 results with adjusted EPS of $1.18, handily beating the 1.03 consensus. EQ2 management points to a tightening market ahead. They note that U.S. gas production needs to exit 2025 at 108 billion cubic feet per day and approach 114 BCF a day by the end of 2026 as demand accelerates with new LNG facilities coming online. The current production growth in the Permian and Haynesville simply won't be enough to offset the demand surge. The company is positioning itself accordingly, acquiring Olympus Energy in a strategic move expected to generate approximately $530 million of EBITDA and $270 million of unlevered free cash flow over the next 3 years. They've also raised their standalone 2025 production guidance by 25 BCFE, while lowering capex guidance by $25 million, a testament to their operational efficiency. Here's something not enough people are talking about. Data centers are creating significant new demand for natural gas. EQT anticipates these projects could drive an additional 6 to 7 BCF a day of regional demand growth by 2030. That's a massive new source of consumption that could fundamentally alter the supply-demand balance. With faster than expected ramps at Plaquemines Phase 1 and startup of Golden Pass LNG later this year, the natural gas market is poised to tighten considerably in 2026. The divergence between oil and gas markets creates a clear investment thesis. Companies with strong balance sheets and exposure to natural gas are positioned to outperform. Analysts are highlighting ExxonMobil, COP, CNQ, EQT, BKR as preferred plays in this environment. EQT in particular looks well positioned. They exit Q1 with $8.1 billion of net debt and plan to exit 2025 at $7 billion well ahead of their $7.5 billion target by mid-2026. Their integrated operation strategy to capture in-basin demand and tightening gas basis makes strategic sense in the current market. The energy sector is facing a tale of two commodities. Oil markets are laboring under the prospect of 2025 oversupply, with OPEC Plus adding fuel to that fire. Meanwhile, natural gas remains structurally advantaged due to consolidated supply and clear visibility toward growing power and export demand. Smart money is shifting towards gas-weighted producers with strong balance sheets and operational efficiency. As the market continues to evolve, those who can navigate these divergent trends will be the ones who thrive. Mark Roach, FutureWise Energy, signing off.